If I had to guess one of your biggest struggles in trading, it would be not knowing when to take your profit or let the trade run to its full potential. You often exit a profitable trade with a small amount, missing a huge opportunity, and other times you leave the trade open just to see the price come back to your entry level. What if I told you I have a solution for this? It involves using Bollinger Bands, and it will help you finding the trend in a second, and you'll know exactly where to set your targets and stop orders. You know the drill. Like, subscribe, and stick around for the full video. Let's start with the setup of your chart. This may look weird at first. We'll use not one, not two, but 3 Bollinger Bands. First Bollinger Bands indicator will have a period of 200 and a standard deviation of 1. The second one will have a period of 200 and a standard deviation of 2. And the third one, the same 200 period and a standard deviation of 3. And make the middle Bollinger Band more obvious, increase its thickness, and also change its color. Now, the main advantage of this setup is the fact that Bollinger Bands use standard deviation to establish where hidden support and resistance levels might be found. These are also known as volatility channels. A volatility channel plots lines above and below a central measure of price. These lines widen or contract depending on how volatile or non-volatile a market is. With this setup, you will read the trend's trend. You will time your entries during trends and during range markets, and you'll also find potential reversal points in a dynamic, adaptive manner. I don't know about you, but for me, with this setup, the trend is pretty obvious. In this example, I see an uptrend, but with different phases. When price is located between the middle line and the first band, we have a weak uptrend. When the price gets within this area, there is no strong momentum, and the price is likely to fluctuate within a range and may even go below the middle line. You can enter a buy trade in this area, but only if you have confluence with other factors. We'll talk about this later. When price is located between the first band and the second Bollinger Band, we have a strong uptrend. There is a higher chance that the price will continue upward. As long as the candles continue to close in this buy zone, the odds favor maintaining current long positions or even opening new ones. When price is located between the second band and the third Bollinger Band, above the middle line, we have a very strong uptrend. Price is overextended, and I would avoid buying if price goes outside the bands. In this area, if you are experienced, you could look for divergences to find reversal signals. Again, we'll talk about this later. And here's a downtrend. Price is below the middle line, between the 200 moving average and the first band. This is a weak downtrend. There is no strong momentum yet, and the price is likely to fluctuate within a range. When price is located between the first band and the second Bollinger Band, below the middle line, we have a strong downtrend. There is a higher chance that the price will continue downward. And when price is located between the second band and the third Bollinger Band, we have a very strong downtrend. You see how this set of 3 bands will give you a better insight into a trend. You don't just say, yeah, it's a downtrend. You evaluate the volatility and the price location, and you know the strength of the trend, which is more powerful. Now you know the strength of a trend. How and when do you enter? As always, I rely on confluence. The term confluence refers to the overlap of 2 or more key levels or areas of value. These can be trend lines, horizontal levels, and even other channels. Let's use simple support and resistance levels. Looking for overlaps of key levels with Bollinger Bands is an excellent way to find high probability setups. These areas of confluence tend to attract more buyers or sellers, resulting in a reversal or a continuation of the current trend. With this confluence, you are basically finding pullbacks in a strong trend. When a market is in an uptrend, meaning price is above the middle Bollinger Band, and you find a confluence between a recent support or resistance level and one of the standard deviation bands, you can trade a bounce of that area. On the other hand, when price is in a downtrend below the middle level and the recent support or resistance aligns with one of the lower volatility bands, a decent pullback trade may be on the cards. Here's Euro-Yen. Before finding the confluence trade, just look how price was respecting the bands almost religiously. Even when price was below the middle band, it found support at the lower bands. This alone makes this system a very powerful one. Now look here, price broke above the middle line and also broke this resistance level, which now will potentially act as a support. Here's our value area. The first band above the middle line and this level are aligning on the same point. So a buy trade in the strong trend area is a decent trend continuation opportunity. And look how easy it is to find profit targets. You just aim for the next bands. The first take profit is at the second band, and the next target is the last band. Always expect a momentum loss when price reaches the next set of bands, and always take a part of your profit at these levels so you don't give it back to the market if price finds resistance and reverses. In this chart, price broke below the middle band, entered a weak trend phase, and then also broke this support level. Then it targeted the second band, retraced, found resistance once again at the first band, and then went for the third band. Look how powerful this setup is. Price stopped right at the third band. Then it retraced back up, and here's our value area. The first band below the middle line and this previous breakout level are aligning on the same area. So there's a potential sell trade in the strong trend area. You can enter right after the price touches the band, or you can wait for a rejection signal, maybe an engulfing candle or a pin bar. It's up to you. And you just aim for the next bands. The first take profit is at the second band below the middle line, and the next target is the last band. I said previously that you can also take a trade in the weak buy or sell area. You can do this if you can find a confluence, and this may even offer you a higher risk-reward ratio. Look right here. We had a transition from a strong uptrend to a downtrend. Price patiently found support at each of the previous bands, and now is returning to the middle line. But this area is an important one. I see a supply zone right here, which aligns with the middle line. So yes, you can incorporate this setup into supply and demand trading. Let me know if you want a future video about this. If you are a classic support and resistance trader, you have this breakout zone here, a former support, now potentially acting as a resistance. So a sell trade in this area is worth risking. First band below the middle line is the first take profit area. The second band is the next area, and finally the third band. And please don't wait until the third band is reached to exit. Take partial profits at each band and be conservative. Heikin-Ashi candles work very well in combination with this setup and will make your trading a lot easier. Heikin-Ashi shows the average price movements, creating a smoother chart which helps to identify market momentum more easily. You have the trend with the help of Bollinger Bands, and now you add the momentum aspect using Heikin-Ashi candles. If you don't like classic candlesticks that may flip-flop constantly from a green bar to a red bar to a green bar once again, maybe you should try Heikin-Ashi charts, because they tend to have longer stretches of green and red bars. When the market is above the middle Bollinger line, look for Heikin-Ashi candlesticks that have big bodies and long upper shadows, but no lower shadows. When the market is below the middle line, look for Heikin-Ashi candlesticks that have big bodies and long lower shadows, but no upper shadows. What I like about them is the fact that small corrections and consolidations are somewhat left behind, and they are barely visible on the chart. You will also notice that when the direction changes on a Heikin-Ashi chart, the price will most likely go to the next set of bands. Also, the market noise is filtered, so maybe there's a less chance you'll be distracted from a choppy price action. And again, you look for support and resistance levels and important swing points to find confluence levels. If you want to catch reversals, you could trade divergences after price spends a lot of time in the very strong trend territory between the second and the third band of the setup. A divergence is an event that is associated with increased levels of volatility. I've added the MACD histogram to easily spot points of inconsistency between price and the indicator. A bearish divergence is when the market makes a higher high, but the MACD shows a lower high, which is a sign of weakness. A bullish divergence is when the market makes a lower low, but the MACD shows a higher low, and this is a sign of strength. You want the signal to appear when the price is near the outer limits of the bands. And here's the trick: when you find the divergence, you don't enter at the third band, you enter at the second one. This is a riskier trade against the trend, and you know that price likes to rest at the Bollinger Bands before continuing its move. So you wait for a movement at the second band, then you target the first band, and the middle line as the final target. But most of the time, you'll have a decent win rate if you just target the first band. Here's Bitcoin. We see a price move outside the bands, while the MACD indicated a bearish divergence. This suggests weakness and the potential reversal to at least the first band, and maybe even the middle Bollinger Band. Very important, always wait for a trendline breakout before entering into a divergence trade. This will filter a lot of fake divergences. You want to enter after a trendline breakout, somewhere around the second Bollinger Band, with a stop loss above the third band. Again, this is a riskier trade, so if it's not your style, stick to the trend continuation setups. Now, if you want to learn more about finding the best confluence signals, make sure you watch this video here. It contains many tips and tricks you could add to your arsenal. And check out our Academy program if you want to further level up your trading. Until next time.